Hey guys, we've got a lot to talk about. Obviously, by now, you've heard a lot about the invasion of Ukraine. No doubt that this is a very serious situation and it will lead to a regrettable loss of life. That being said, this invasion is having a large impact on the stock market and we need to talk about it. Just so you know, I'm recording this on the evening of Friday, February 25th. So by the time you see this video, things might have changed since this is a very dynamic and rapidly changing and evolving situation. So bear with me on that. Today I want to talk about the stock market and why it is doing what it has been doing. I'm going to start in January of 2022, what stocks started doing then, and what they have done in the last 2 or 3 days. So let's get started. Let me start by talking about my favorite ETF, the S&P 500. A lot of people use ticker symbol SPY to follow the S&P 500. I use VOO. It doesn't matter which one you use. Although I will say that the expense ratio of VOO is 0.03%, whereas that for SPY is 0.09%. So personally, I don't understand why anyone would use SPY and pay 3 times as much for the same thing. But to each their own. Let's take a look at this chart. On January 3rd of this year, the first trading day of 2022, VOO is trading for about $440. Basically all-time high. Since then, VOO has continued to fall. It is an awful story of a red day after red day. On Wednesday, February 23rd, VOO closed at 388, down 11.8%, basically 12%. This means that the S&P 500 was squarely in correction territory, which is defined as a 10% downward movement of its recent or latest high. So why is this happening? To put it simply, the Fed is stopping the party. To really understand what's going on, we have to go all the way back to March of 2020. When Roni Rona first came on the scene, everyone went into lockdown and we were all forced to curtail our economic activity. The stock market plunged, GDP growth slowed down, unemployment claims rose up, and we actually entered a recession. So what did Congress do? They quickly passed stimulus legislation. They gave direct money in the form of direct checks to Americans. They gave money to businesses in the form of PPP loans. They gave mortgage forbearances, rental assistance, and so on and so forth. But what did the Fed do? Lowered the benchmark interest rate to 0%. This makes accessing credit extremely cheap for people across the board. For example, 30-year mortgages were being given out at less than 3% interest rate. But why did the Fed do this? Why did it lower the benchmark interest rate to 0? You see, the US Fed uses a monetarist economic theory. So what is the monetarist theory? Let's see what Investopedia has to say. The monetarist theory is an economic concept that contends that changes in money supply are the most significant determinants of the rate of economic growth and the behavior of the business cycle. When monetarist theory works in practice, central banks, which control the levers of monetary policy, can exert much power over economic growth rates. What this basically means is that the central bank, the Federal Reserve in the US, can change the supply of money in the market and thus affect economic output. For example, when the Fed lowered interest rates to 0 in 2020, it made it very, very cheap for people to borrow money. The thought is that people will borrow more money and then use that to invest it back, hopefully, in their businesses by buying more machinery or hiring more people, and that would increase economic output. So this is good, right? Yeah, it was. Back then, we benefited greatly, all of us, from these extremely low interest rates. The recession only lasted for 2 months, the economy came back really strong, and the stock market started roaring upwards, and it continued to go up till December of 2021. So why is the Fed stopping the party now? In one word, inflation. You see, what happens when you lower interest rates is that people start borrowing more money. That's the intent. They will borrow this money and they will expand their businesses. They'll buy more machines, they'll hire more people, and so on and so forth. Now, over the last 2 years, our supply chains are constrained, our ports are backlogged, and it is harder and harder for businesses to hire people. Now, this has done 2 things. Number 1, wages have gone up across the board. It is not uncommon to see our Target hiring new employees starting at $16 an hour. 2, it has become harder and harder for us to buy the things we want. So what do people do when they have a lot of money and they are unable to buy the thing that they want? They are willing to pay more money for the same product. This means that the companies that are making and selling those products can charge more for their products and use some of that extra money to pay their employees more. And the cycle keeps going on and on and on. And this is called inflation. Now, some inflation is a good thing. In fact, the Fed has a long-term inflation target of 2% for the United States. But currently, we are seeing inflation at 7% year over year. So things today are costing much more what they cost last year. Meat prices have gone up significantly, and I'm sure you've all felt the pinch at the gas station. I know how much it hurts to pay more than $4 a gallon at the gas station, especially knowing that I was paying $2.50 about 2 years ago. So what can be done when inflation runs super high? Well, the Fed increases interest rates. This has the opposite effect of decreasing interest rates. When people's borrowing costs go higher, they tend to not borrow as much money, they tend to spend less money, and this calms the economy down. Now that we've seen inflation increasing month over month, it is widely expected that the Fed will increase its benchmark interest rate at its next meeting on March 16th. The first one of these rate hikes is expected to be 25 basis points or 0.25%, but some analysts are still thinking that it may be as high as 50 basis points or 0.5%. This is precisely the reason that stocks have been doing so poorly in the first quarter of this year. Investors don't like the fact that interest rates are going up. This means that the companies they invest in will have to pay more to borrow more money. They will have lesser profits. In addition to that, the markets are a little bit uncertain about two things, and we all know that markets hate uncertainty. The first one is how much is the Fed going to increase the interest rate? And second, how many rate hikes are going to be there this year and in the next year? Currently, my bet is that the Fed will increase interest rates by 25 basis points or 0.25% on March 16th, and then do so again 3 more times throughout the year for a total of 4 hikes, so that we end the year at about 1% interest rate. Rising interest rates combined with the Omicron surge that we all saw after Christmas has been the biggest reason that stocks have been falling down since January 3rd, when stock market opened for the first time in 2022. Over the last few weeks, stocks rose a bit, falling again after February 9th. Of course, at this time, we started getting news that Russia was starting a buildup of troops on the Ukrainian border. Once again, investors hate uncertainty, and we were not sure what was going to happen next, and because of that, the stock market started falling again. Well, if it was unclear what the troop buildup was for in the last few weeks, this week it became abundantly clear. When the invasion started, we saw a huge sell-off, but then markets rallied and it closed Thursday in the green. And that brings me to today, Friday, February 25th. Overnight from Thursday into Friday, both the S&P futures and Dow futures were down in the red, but they recovered overnight so that by the time market opened, we opened in the green. By the way, I do a daily check on the markets at market open and market close on my Instagram stories. So if you wanted to check that out, go ahead and just search for me at Prashant Kuchi on Instagram and you can follow me there. Anyway, after that market open, we had a spectacular day in the stock market today. I'm not gonna lie, I was prepared for a red day today, especially considering all the awful news that was coming out of Ukraine. But the market surprised me today. The S&P 500 closed 95 points higher, which is 2.25% higher. And the Dow gained 834 points, also closing about 2.51% higher. By the way, this is the best single day the Dow has had since November of 2020. So basically a year and 3 months since the last best day. It was incredible. So the question is, why? Why did the stock market have a rally yesterday on Thursday and an even bigger rally today on Friday, especially when we are getting such awful news out of Ukraine? So this is my thought. I think when the news of the invasion first came out, investors freaked out, sold a bunch of their stocks, and moved their money into safe havens like gold and US bonds. But later in the day, when investors started seeing more news come out, maybe they thought that things weren't as bad as they expected it to be. Don't get me wrong, I think what's happening in Ukraine is awful, but the market just tends to behave pretty strangely in times of distress. So let me show you this graphic. A user, One Reason Why, posted this on Reddit on Wall Street Bets. I know. I went through the data and verified both the dates on this data as well as the stock market movement that's shown on this graphic. So let's take a look at this. Since the 1960s, this graphic shows us the start of 5 wars. And each time we see that the S&P 500 did poorly just before hostilities started and then went on to do well. Just take a look at this. First, the Vietnam War. Stocks fall, the war starts, and stocks rise. Gulf War. Stocks fall, war starts, stocks rise. Afghanistan War. Stocks fall, war starts, stocks rise. Although in this case, the stocks fell again and we did not return to pre-war levels for about 3 to 4 years. Long time. Iraq War. Stocks fall, war starts, stocks rise. Crimean invasion. Stocks fall, war starts, stocks rise. So the question is again, why? Why do we see this pattern repeating itself over and over again? This is because of peak fear. You see, wars don't start like that. Usually there will be a period of where a country will gather its troops, move its hardware into position, and then start a war. This is exactly what we saw right now, where we have been seeing for weeks that Russia had amassed over 100,000 troops on the borders around Ukraine, and then the invasion started. So investors obviously tend to watch these movements very, very carefully. And as these troop buildups happen, as the tensions, the geopolitical tensions rise, investors' fear rises. And just before invasion, the fear is at peak levels and people start selling stocks and moving their money into safe havens like gold. After hostilities start, investors start to reassess what's going on, what's happening, kind of get adjusted to the new normal, and then it's back to business, unfortunately. There are also people who see the dip as a buying opportunity and might decide they want to jump in if they're not too worried. I think this is what happened yesterday as well as today. People, myself included, took advantage of the dip and bought into the market at a lower cost basis than they would have had if they'd bought at the top of the market at the end of December of 2021. So this is not to say that I personally have completely shrugged off this news. Not at all. On the contrary, I believe that we will continue to see volatility in the stock market till this situation reaches some sort of a conclusion. Towards the close of the trading day today, news started coming out that both the Russian and Ukrainian sides have started talking about having high-level diplomatic talks between the two leaders towards cessation of hostilities. Obviously, this is a sliver of hope in a sea of bad news. I think this might be part of the reason that investors are starting to feel a little bit more confident and are starting to reinvest into the market. So all in all, I think this is a super volatile time, both for the stock as well as the crypto markets. Now, over the weekend, while the markets are closed, we will have to monitor what happens in Ukraine. The news coming out of Ukraine will be the biggest mover of crypto over the weekend, and we'll have to see where we stand on Monday morning. If the conflict situation in Ukraine stabilizes by then, I think potentially we could see a green day. But at the same time, if the situation does not improve or gets worse, I think we might have a red day on Monday. So that's all I have for you guys in today's video. Please go ahead and smash the like button and the subscribe button for the YouTube algorithm, and click the bell icon to be notified instantly when I post a new video. Also, go ahead and follow me on Instagram if you want to be a part of my daily market open and market close updates over there. Thank you so much for watching, and see you next time.